Hello, welcome back to the second part of our lecture 1, and we were discussing level of assurance, and I have told you two different levels of assurance, and we move on. So what does limited assurance engagement mean? In a limited assurance engagement, the practitioner, the auditor, gathers sufficient appropriate evidence to be able to draw limited conclusions, and he or she concludes that the subject matter with respect to identified suitable criteria is plausible in the circumstances, and they give a moderate or lower level of assurance than the audit. In this one, they perform significantly fewer procedures because of the level of engagement, and mainly inquiries and analytical procedures. How do they describe this low level of assurance, which is a negatively worded? Here's the example for that. And they will mention that nothing has come to our attention that causes us to believe that the financial statements of XYZ company as of 31st of December 2016 are not prepared in all material respects in accordance with the applicable financial reporting framework. That is the statement that they will put. This low level of assurance is sometimes negatively worded, which is a negative assurance. As for the reasonable assurance engagement, an audit gives the reader reasonable assurance on the truth and fairness of the financial statements, which is a high but not absolute level of assurance. The auditor's report does not guarantee that the financial statements are correct, but they are true and fair within a reasonable margin of error. One of the reasons that auditor does not give absolute assurance is because of the inherent limitations of audit, and we will discuss these limitations later on. So what does reasonable assurance mean? The confidence level in reasonable assurance, such as an external audit report, is designed to be greater than limited assurance report. In this one, therefore, there are many regulations and standards governing a reasonable assurance assignment. These procedures carried out in a reasonable assurance assignment will be more thorough compared to the limited one, and the evidence gathered will need to be of higher quality. Let's see the example how the auditors, the practitioners, describe or give a positively worded assurance opinion. Here's the example, and they will say, in our opinion, the financial statements give true and fair view, or sometimes they might use the financial statements give present fairly, sometimes they use, in all material respects, the financial position of XYZ company as of 31st of December 2016 and its financial performance and its cash flows for the year ended in accordance with international financial reporting standards. And that is the example for the positively worded assurance opinion by the practitioners. What's the objective of external audit of financial statements? Remember that the objective is to enable the auditor to express an opinion as whether the financial statements are prepared in all material respects in accordance with applicable financial reporting framework. So that's the objective of external audit. So that auditors express their opinion whether the financial statements are presented fairly and then give a true and fair view, which we just saw in the example. Does audit proves financial statements are 100% correct? And we have discussed it. And audit gives opinion on true and fair. In here, you need to understand true and fair and the meaning of true and fair. True means the information is factual and conforms with reality. In addition, the information conforms with required standards and law. The financial statements have been correctly extracted from the books and records. That's the meaning of true. As for the fair means information is free from discrimination and bias, and in compliance with expected standards and rules. The accounts should reflect the commercial substance of companies' underlying transactions. External audit gives a reasonable assurance that the financial statements are free from material misstatements. That is the meaning of fair. How about reasonable assurance? Reasonable assurance is that the financial statements are free from material misstatements. Again, when we are talking about the financial statements being 100% correct or not, then we need to discuss some of the things. So why doesn't an external audit give absolute assurance over the truth and the fairness of financial statements? And we mentioned that because of the inherent limitations of external audit, which we'll discuss later on. The key thing to remember is that external audit can never give absolute assurance to shareholders. This is the fact. Only they give only reasonable assurance. One of the thing is the materiality. Errors considered within materiality. Let's imagine the materiality is an expression of relative significance or importance of a particular matter in the context of financial statements as a whole. A matter is material if its omission or misstatement would reasonably influence the economic decision of users taken on the basis of the financial statements as a whole. So materiality depends on the size of the item or the error judged in a particular circumstance of its omission and misstatement. The auditor's task is to decide whether the financial statements show true and fair view. Auditors are not responsible for establishing whether the financial statements are correct in every particular way. This is because it can take a great deal of time and trouble to check the accuracy of even a very small transaction, and the resulting benefit may not justify the effort. Also, the financial accounting inevitably involves a degree of estimation, which means that financial statements can never be completely precise or accurate. So that's the reason that financial statements cannot be 100% correct. But auditors will not give you the 100% accurate, or auditors will never say that they will give you the absolute assurance to the shareholders. The benefits of audit. What are the benefits of audit? You need to have a higher quality information, which is more reliable, giving investors faith in the market and improving the reputation of the market. The second one is independent verification may be valuable to the management. And also it reduces the risk of management bias, fraud, and error. It enhances the credibility of the financial statements. And also the deficiencies in the internal control system may be highlighted by the auditor, because auditors, when they give their opinion, also they will make a note of some of the deficiencies in the internal control system. What is the expectation gap? Some users incorrectly believe that the audit provides absolute assurance, that the audit opinion is a guarantee that financial statements are correct. This and other misconceptions about the role of auditor are referred as the expectation gap. That's what we mean by expectation gap. So we established that financial statements are not accurate, and also the auditors will not give you the absolute assurance. Okay, so if we understand that, then we know there are some people who believe into that. So this is what we call expectation gap. The examples for the expectation gap is a belief that auditors test all transactions and the balance. So auditors, when they come in, they will not check all transactions. They will have samples they collected from each transaction, and they will only check those samples. So the audit is based on sample, and those samples are checked. If they are correct, then if they're satisfied, then obviously they have this evidence, and based on this sample evidence, then they will give you the audit report. Also, a belief that auditors are required to detect all fraud, and that is not true. Auditors are required to provide reasonable assurance that the financial statements are free from material misstatements, which may be caused by fraud, but they will not detect all fraud, because it's again based on the sampling basis. And there is another belief that auditors are responsible for preparing the financial statements. As we mentioned, as we established at the beginning of the lecture, is that it's not the job of the auditors to prepare the financial statements. It is the job of the directors who prepare the financial statements. And then those directors who prepare the financial statements, the auditors will come and check those financial statements. What are the limitations of audit? And the limitations can be, the audit report has some limitations, examples for limiting words and the standard format that they have. Also, the audit reports long time after the year-end date, because the directors prepare the financial statements, and the audit comes in afterwards, and then they give their opinion. Another one is it indicates the probable, not certain. There are some certain areas, and it's gray areas, that auditors will not be able to do their job in terms of establishing their job, giving their report. Also, the limitations in accounting and the control system. For example, there are human errors also. Sometimes the audit company colludes in fraud. So these are the limitations in, for example, in human error or the collusion in fraud. Again, another limitation that we mentioned, that because audit reports are based on the sampling, so not all items in the financial statements are tested. So if the sampling that they have taken from each transaction, if sampling is correct, or all the samples that they have collected are all correct, then they will base their opinion based on those samples. Again, they are not going to check all the items in the financial statements. So it's based on the sampling. And then the last one is auditing is not an objective. Rather, it's judgments have to have been made, or judgments are made during the making it, during establishing or giving their opinions. Let's do some examples. Those examples are the previous exam questions, and see whether you have understood chapter 1 and chapter 2 correctly. Which one of the following statements relate to review engagements? And we have mentioned what the review engagements are. The first one is the subject matter is plausible. Second one is reasonable assurance. Third one is nothing has come to our attention, which would indicate that the subject matter contains material statements. And the fourth one is a positive assurance. So which one of these two, which one of those two of them, which one of them are related to the review engagements? Take your time, go back to your notes, and try to do this question. As I mentioned when explaining that reasonable assurance and positive assurance are provided by the external audit. And there is a second one, which is a review engagement provides only limited assurance. So the answer for this question is going to be 1 and 3A. 1 is subject matter is plausible, which we mentioned, and the third one is nothing has come to our attention which would indicate that the subject matter contains material misstatements. Let's do another question. You are the newly appointed auditor of Jones Co., a company which has previously had not had to have an external audit because of its size. The owner of the company does not fully understand why an external audit cannot provide complete assurance over the truth and fairness of the accounts. Explain the inherent limitations of external audit to the owner of Jones & Co. So your job is to explain the owner of this company is why the audits will not give you the true and fairness of accounts, complete assurance. Here you need to explain the inherent limitations of external audit. The answer for this one is, obviously you need to explain to the owner of Jones & Co. that the external audit can only provide a high level of assurance over the truth and fairness of the financial statements, but it cannot ever provide absolute assurance because of the number of reasons, and which we have discussed it before, including the inherent limitations in the accounting and control systems. As the external auditors will not test 100% the transactions, doing so because they based on the sampling, doing so would result in a huge input of costs and time. Instead, auditors apply professional judgments and the concept of materiality. Another thing is you can explain that evidence that the auditors obtain may sometimes only indicate it is probably not certain. This applies to the figures that are subject to estimates and the judgments of the directors. For example, the provision in terms of the provisions. Auditor's report has limitations and is issued sometime after the reporting date to the financial statements. And another question that has been asked previously is describe the level of assurance provided by external audit and review engagements. So what you need to do is differentiate between the external audit and review engagements, and then explain those questions. In terms of the external audit provides a reasonable assurance but not the absolute assurance, and the reasonable assurance is high but not absolute in terms of the level of assurance. This provides comfort to the financial statements, present fairly in all material respects, or you can say true and fair, free from material misstatements. As for the second one, review engagements, the review engagements provide limited assurance, and this limited assurance is a lower level of assurance where the practitioner gathers sufficient evidence to be satisfied that the subject matter is plausible. In this case, and this negative assurance is given where the practitioner confirms that nothing has come to their attention, which indicates that the subject matter contains material misstatements. So for you is to read BPP study manual, chapter 1, and also now we're going to go and discuss the chapter 2. For you to read the chapter 1, and now we're going to move on to the chapter 2, and for you as a homework, you need to read the chapter 2 as well. Chapter 2 is about the statutory audit and the regulation, and we're going to discuss what implied in the audit opinion, and what are the appointments, the removal or resignation of the auditor, and the regulations of auditors. What's the objective of statutory audits and the audit opinion? As we discussed in the chapter 1, the purpose of audit purpose of an audit is for the auditor to express an opinion on the financial statements. An audit opinion may also imply certain things are true, because otherwise the auditor's report will have mentioned them. For example, in the UK, such implications include the following: maybe adequate accounting records have been kept, returns adequate for audit have been received from branches not visited, and also the accounts agree with the accounting records and returns. All information and explanations have been received that the auditor believes are necessary for the purpose of audit, and details of directors' emoluments and other benefits have been correctly disclosed in the financial statements. Particulars of loan and other transactions in favor of directors and others have been correctly in the financial statements. So as you can see, as for the audit report to be true, they need the practitioner need to obtain those information. So what happens on an audit? On an audit, we have internal audit and final audit. So the internal audit are done just before the year ended. So this is just a plan and document and learn about the company. As for the final audit, they are done after the year has finished, when we have published our financial statements. Who's going to be in the audit team? As for the hierarchy of audit team, is going to be at the bottom is going to be the new staff accountants or junior assistant. They will typically the first position, someone who comes to the accounting profession. They will do the jobs. They are the new member of staff, accountants. They will do the job. And then above them they have senior accountants. They are in charge of the team and typically have 2 or more years of experience in public auditing. They run those new staff members, new accountants. Above the senior account, they will have a manager who supervises an supervises the audits and conducted by the senior accountants. Above the manager, they will have either a partner or director of the firm, the accounting firm. Obviously, when the audit is done, you will only have a new member of staff accountants. They will be doing the mainly job, and then they will have a senior accountants who are supervise the new member of staff. And maybe the managers sometimes come and visit them while they're doing the audit job. What are the rights of an auditor? Auditors have several rights, and which we need to mention them. If we understand their rights, then we understand their job properly. So the first one is they have a right to access every single records of the company. So a right of access at all times to the books, accounts, and the vouchers of the company. So they will have this right. So nobody's going to come and say you are not allowed to touch this book, or you're not allowed to access to that account. So they have full access. The second one is the access to record in terms of the I don't know why I put it twice in there. I need to delete that one. So information, the second one is information and the explanation. A right to require from the company's office such information and explanation they think necessary. So if they think that they need extra information, they can ask the company to give them those explanations if they think that is necessary. Next one is attendance at the annual general meetings. They have a right to attend any general meetings of the company, and they also have to receive all notes from those meetings. And they have also a right to be heard at the general meetings, a right to be heard at the general meetings which they attend on any part of the business that concerns them as auditors. If they think that that this meeting is somehow related, or it gives them some sort of evidence or information, then they have a right to attend those meetings. And also the last one is a right in relation to written resolutions. So they have a right to receive a copy of any written resolutions proposed. Having learned rights of the auditor, let's discuss the duties of auditor. And auditors must consider the following. They need to comply with the legislation, whether financial statements have been prepared in accordance with the relevant legislation or not. So they must comply with the legislation. Next one is the truth and fairness of the accounts. Whether the financial statements, the statement of financial position, shows true and fair view of the company's affairs at the end of the period, and the statement of financial and profit and loss account or the cash flow accounts show the true and fair view of the results for that period. So that's their duty. Adequate accounting records and returns. Whether adequate accounting records have been kept and the returns adequate for the audit received from the branches not visited by the auditor. So what they need to have, and they have a duty to adequate accounting records has been kept by them, and this is their duty. Next one is agreement of accounts to records. So they have a duty to check that all accounts are in the agreement with the accounting records and returns. So they have to check it. Not absolute all of it, but we are talking about the sampling. Also, they have a consistency of other information. Whether the information in the director's report is consistent with the financial statements or not. This is their duty to check. Also, the last one is to check is director's benefits. So whether disclosure of director's benefits have been made in accordance with the Companies Act 2006. That's in the UK. So you might have an international one, or the other countries have different rules and regulations. And who is going to appoint auditor? And we have mentioned that the auditors are being appointed by the shareholders. And who else can appoint auditors? So obviously the first one is directors. Directors can appoint auditor before the company's first period for appointing auditors, following a period during which the company did not have an auditor, or the third one is to fill the casual vacancy. And also the members can appoint the auditor by ordinary resolution during the period of appointing the auditors, or if the company should have appointed but failed to do so. If the company didn't appoint the auditor, then they will do so. If the directors fail to do so, then they will also do it. And the last one is the third category is a Secretary of State can appoint auditors if no auditors are appointed above, either by directors or by members. In terms of the regulation of the auditors, why it is necessary for auditors' job are regulated. Regulation or regulators aim for audits to be valuable for both shareholders and the wider public. This is done by having audits performed by independent professionals who work in accordance with the common standards. This helps to ensure that audits are of high quality, which enhance the credibility of the financial statements. It is essential, therefore, for the public confidence in the profession is maintained, because of this will in turn contribute towards the confidence in the financial statements that are audited. The regulatory framework within which the auditor operates encompasses a range of regulations, including the laws, auditing standards, ethical and corporate governance codes, and other guidance issued by the regulatory bodies. This framework provides transparency regarding the standards to which the auditor is expected to adhere, which can be reviewed and revised if required. For example, following a number of corporate scandals, including Enron and WorldCom and other companies, the audit profession came under close scrutiny from investors, by the shareholders and the businesses, and regulators as well, and also from the wider public. As a result of comprehensive changes were made, regulation also provides objective benchmarks against which the audit profession's performance can be assessed. Where auditors do not meet those standards, then disciplinary steps can be taken, and in this way the integrity of the profession is maintained, enhancing the public confidence in the quality of the audits. So for those reasons, the auditor's job needs to be regulated, because if they are regulated, then obviously they will give us, they will ensure that audits are in a high quality, and also it enhances the credibility of the financial statements, and also it maintains the public confidence in the auditing profession, and also it provides the objective benchmark against the audit profession's performance, and that can be assessed, that the disciplinary steps can be taken if auditors do not meet the standards. Let's do one test, and we conclude our second part of our lecture. So, what position would make a person ineligible for appointment as a company auditor? So for this one, we mentioned that an officer or employee of the company, so they cannot, these people are not ineligible for the appointment as a company's auditor. Second one is a partner or the employee of such a person. And the third one is the partnerships in which such a person is a partner. So this is a conflict of interest again. So this is the end of our lecture 1, part 2. And for you as a homework, please read chapter 1 and chapter 2 before you come to the lecture class, or before you come to the seminar class. And I look forward to see you in the seminar class as well. Thank you very much.